So it's the beginning of December. You've got less than 30 days before the clock strikes midnight on 2025. And with that, your last shot of locking in critical tax strategies for your business. But what if you feel behind, maybe even overwhelmed? Listen, that's more common than you think. And today I'm breaking down the essential year-end tax moves that you can still make. I'm going to talk about what to prioritize and why 12/31 isn't just another deadline. It's your final opportunity to save big. All right, let's go ahead and dive in and get you started fast. The first thing I want to talk to specifically is to those S-Corp owners out there. So if you're the owner of an S-Corp, there's a few things that you specifically need to do that maybe if you're operating as a sole proprietorship or a partnership that you might not need to focus on. But as an S-Corp owner, there's three main things. The first one is a reasonable salary. Now, if you've been operating as an S corporation, and we talk about it all the time here on our podcast or YouTube channel, we constantly talk about how you need to have a reasonable salary as an S Corp owner. So now is the time to make sure that if you haven't ran a salary, you got to do that. You have to have that salary ran by 12/31. But now is also a good time to see is where's your salary at? Is your salary at a reasonable level? Or do you need to run a little bit of a bonus payment? Maybe just move some owner draws into reasonable comp. You can still do that. But now is the time to check to make sure, is that salary reasonable? Is your salary number right? Run the numbers, see what that reasonable salary is. And within TaxOn, we have a worksheet that helps you determine that reasonable salary. But run those numbers. If you haven't ran a salary yet, do that now. Do not take another minute. Go start to make sure you run that salary. If you have been consistently running salary, see if maybe you need to bump it up a little bit, or maybe even you can hold back a little bit. Maybe you're not going to take salary the rest of the year if you're already at that reasonable number. Bottom line is make sure you get that reasonable salary done. The second thing for S-Corp owners is self-employed health insurance. So if you are paying for self-employed health insurance out of pocket, you need to treat it a specific way as an S-Corp owner. And what you need to do is you need to run those payments through the business. Now, if you've been paying for them personally, fine, just create a reimbursement through an accountable plan, which we'll talk about next. But make sure the business is taking a business expense for those self-employed health insurance premiums. You then need to add them to your W-2 to box 1 and box 14. So it's not going to be subject to Social Security tax, Medicare tax, which is box 3 and 5 earnings. You're just adding it to box 1 earnings. But that's a process that you need to do. You need to contact your payroll provider, whether you're using Gusto or working with somebody else, whatever it might be. You need to make sure that those self-employed health insurance make it onto that W-2. Now, you're going to get a deduction for it again on your personal tax return, but you need to go through that process to get it added to that W-2. So that's an important step. And now one thing to also consider is that self-employed health insurance premium, that amount that you add to your W-2, that counts towards your reasonable salary. So let's say you determine, you run through the worksheet, you do everything else, and you determine that your reasonable salary is $80,000. Well, if you've already ran $70,000 in payroll and you have additional $10,000 in self-employed health insurance, you're done. You can stop because you're going to add that self-employed health insurance through your payroll provider. It's going to bump you up to that 80 number. So make sure that you work with your payroll provider to add that self-employed health insurance and make sure that they're doing it correctly. Make sure you let them know that you are an S-Corp owner and it's only going into box 1. It's going to be different for anybody else. If you're paying for health insurance for employees, completely different. But for S-Corp owners, box 1. So the first one is reasonable salary. Make sure you're running that. 2, make sure you contact your payroll provider and add any health insurance premiums if you have those. And number 3 is an accountable plan. Accountable plan is just a simple word for a more complex word for a reimbursement policy. It's a way to reimburse yourself for items that you paid for personally that are business related. With an accountable plan, make sure you have it set up, make sure you have it in place, and make sure you make any final reimbursements before 12/31. As an S-Corp owner, this is how you get that deduction for your home office. This is how you get that deduction for automobile expenses. Any items that you have business and personal mix, you're going to use an accountable plan to get the business expense, reimburse yourself. As long as you have that accountable plan in place, tax-free income to you. So make sure you're making those final reimbursements related to an accountable plan. If you don't have any of this set up, now's the time to get cooking on that. This is stuff that has to be done by 12/31. So as a recap, S-Corp owners, reasonable salary, self-employed health insurance, and make sure that accountable plan is set up and reimbursements are made. The next thing I want to talk about is maximizing deductions. And we talk about maximizing deductions in general all the time and how we can move after-tax spending into pre-tax spending, making sure we have a business purpose for a lot of this spending. But now as we're getting close to year end, I don't want to dive into that. I just want to talk about what can we do now, or what can we make sure that we've buttoned up and done what we can up to this point. The first thing I always recommend is go through your personal statements and see if there's any business or at least partially business items that slipped through the cracks that you accidentally paid for personally but were actually business related. Run through your personal statements and see if there's anything you can do there. And if there is, great, add it to your accountable plan, include that as part of your reimbursement. Think of things like meals, travel, technology costs, subscription services. All those, if there's a business and personal mix, if it's business related, obviously it's a full reimbursement. If it's an item, let's say it's a Costco membership, and you buy business stuff at Costco, you buy personal stuff at Costco. And if it's about 50-50, well, if you paid for that Costco membership personally, you should be reimbursing yourself from the business via an accountable plan for 50% of that cost. So go through your personal statements and see if there's any opportunities there that maybe slipped through the cracks that you haven't thought about or you didn't think about the business purpose at the time of swiping that card. Number 2 in maximizing deduction is hiring your kids. I believe that any business owner with kids at least roughly age 7 up to about 18 should be hiring their kids in your business. So if you have kids in that range and you have not hired your kids, maybe put this on a checklist of something you're for sure going to do next year, but there is time, there is opportunity to still do that this year. So make sure you're doing that. If you are hiring your kids, take this opportunity to just button things up a little bit. Make sure that you're doing things correctly. Make sure you have the documentation to support the hiring of that kids in your business. The third item I want to talk about is the Augusta Rule, or the 14-day home rental rule. Make sure that if you're utilizing this rule, and this is a way to rent your home to your business for business-related events. This is separate from the home office. This is in addition to the home office, but maybe you're having board meetings at your home, or maybe you're having team retreats, or clients staying over, or team members staying over. Whatever it might be, if you rent your home for 14 days or less, you do not pay taxes on that income. And so if your business was using your home outside of your home office for various different events or people staying over that are business related, make sure you set up that Augusta Rule. Make sure you have all the documentation to support it and in place and a reasonable rate, a reasonable comp. You find out what a reasonable rental rate is, and then make sure you make that payment from the business to your personal account for that piece. Make sure that's done before 12/31. The next item I want to talk about is a boardroom, making sure that you're completing your board meetings. So as part of the Augusta Rule, a lot of times people use board meetings to help make up for that Augusta Rule, to help give events at your home for that. But either way, make sure you're doing a board meeting, making sure that you have a board meeting on the books, and any expense and costs associated with that board meeting, making sure that those were taken on your business bookkeeping file as well. And then of course, home office and automobile. So home office and automobile, that's gonna be part of the accountable plan. Unless it's an automobile, it's 100% business. Obviously we're running that through the business. But if it's got business personal mix, oftentimes we're gonna see that on the personal side. Make sure you're making that reimbursement through the accountable plan. If you're set up as a sole proprietorship or a partnership or something that's not an S corporation, make sure you get all these documents calculated so you can create that expense on your business tax return. Now, the next thing I want to talk about when we talk about year-end is just a few things up against retirement and health. So first off, retirement. If you're funding a 401k, if you're funding, and this is for business related or for your employer, just make sure you complete your employee contributions before year-end. Traditionally, and there's some workarounds, there's some caveats to this rule, but generally stating, employee contributions need to be made by 12/31. So just make sure that you're doing that, making those contribution amounts if necessary. The second thing on the health side is that if you set up a Section 105 plan, this is for a medical expense reimbursement plan. If you have a lot of medical expenses and you're using a strategy to help get a deduction for those via the Section 105 plan, or if you have an HRA plan, a health reimbursement arrangement for your employees, things like that, make sure that you're completing any reimbursements before year end. So just a couple key notes we want to think about. If this is something you're like, hey, that could qualify for that, check out previous episodes, check out previous videos that we did, and put this on your list to say, hey, I'm going to do this next year, because there might not be enough time to do it this year. There might be, depending on where you're at. So just start to look into that. Now, real quick, if you are a business owner and you're tired of guessing when it comes to taxes, we just released a brand new tax savings starter kit, and it's 100% free. Inside, you're going to get our ultimate list of business deductions. You're going to get a real case study showing how we saved others $5,000 or $25,000 or more. And you're also going to get access to a bonus discovery call with our team. Just head on over to taxsavingspodcast.com/starter kit to grab your free copy. Again, that's taxsavingspodcast.com/starter kit. All right, back to year-end items. The next topic that I want to talk about, and I think this is super important, sometimes something that the business owners overlook or don't even think about. but I'm calling it AGI analysis or income analysis. AGI stands for adjusted gross income. So doing an analysis for that. And specifically this comes around phase outs. So we want to see if you're close to phase outs for certain things, we want to look at planning opportunities to bring us below that potential phase out window. We might look at oil and gas investments. We might look at asset purchases, whatever it is. We just want to make sure that if we're close to that phase out range, is there something that we can do here before year end to bring us under that phase to not only get a benefit from whatever that tax deduction is there, but also we're getting the full amount of whatever that phase out might be. And so there's a couple different things that this qualifies for. First one I want to talk about is the QBI deduction, the qualified business income deduction, and specifically for those that have specified service, trade, or business. So oftentimes it's called an SSTB. If you have an SSTB, the QBI deduction starts to phase out once you have income of roughly $395,000 if you're married or $197,000 if you're single. So if you're starting to creep towards those amounts, we might say, let's say you're at 450,000 and it starts to phase out at 395. Well, if we could get a deduction that brings us below that phase out window, not only are we now going to get more QBI deduction, but we're also going to get a benefit from whatever that deduction is. So it might be involved in, hey, I'm going to invest $50,000 in oil and gas, or I'm going to invest, do something with an asset purchase, something like that. Again, we want to make sure that if we're spending money that it makes sense and it's something that's good for our business. Again, I don't want anyone to walk away from anything that we talk about to say, oh, I'm going to go buy something that I don't really need, but I'm just going to go buy it for tax deduction. That's never something that we talk about. I want to make that very clear. But there is opportunities that we could start to lower that income to get us below a phase out range. So main one that we talked about that with a lot is the QBI deduction for SSTBs. Again, starts to phase out when you have income of $395,000 if you're married or $197,000 if you're single. That's when you want to start to look at that. The second piece is the SALT cap. And so this is state and local income taxes, part of itemized deduction, especially if you're in a high income state or a state with high property taxes, this could come into play. Now that cap is set at $40,000, but that $40,000 starts to phase out once you have an income of $500,000. So as we're getting up there, if you have income of $600,000, that cap, that $40,000 cap, you don't get access to. So we want to make sure that that's a big chunk of change that we could, if we can make an investment, do something to help bring us under that cap, it's going to phase us into that SALT cap and can be a double whammy of where you get a tax impact from the tax savings of whatever activity you were part of, but you also brought back more of that SALT cap, which gives you even more tax savings. So some really cool planning opportunities there. Again, sometimes we're investing in oil and gas. Sometimes we're looking at various different asset purchases to accomplish this. But we want to be aware. Where's our AGR at? And are we close to any of these phase out ranges or these caps? The final one I want to talk about kind of in this bucket is long-term capital gains. So if you're married and you have total income of $96,000 to $600,000, your long-term capital gain rate is 15%. If your income is over $600,000, your long-term capital gain rate is 20%. So if you have total income that's starting to hit one of those benchmarks, we might want to look at, hey, how do we get our income below that amount so we can get a lower long-term capital gain rate? If you're single, that total income, if you have income of $48,000 to $533,000, 15% long-term capital gain. Over $533,000, 20% long-term capital gain. So again, there's some planning opportunities there where maybe if we're starting to inch into that 20% capital gain, how do we get back into the 15? Or if we're in that 15 and we have the opportunity to get down into the 0, how do we do that? What things can we do to help us move into some of those different areas? Again, just some AGI type planning that we recommend. The next thing I want to talk about today is timing. Specifically timing for cash-based filers. And when I talk about timing, this oftentimes talks about, moving expenses up or delaying income or various different things. And so I always say, before we talk about these strategies, let's do an analysis. What is this year's income going to look like versus next year's income? If every year is kind of just the same, you're pretty steady, pretty consistent, fine, we can do planning around that. But let's say this year, you're going to have a really big year this year and you expect that to go down next year. Or maybe this year is a down year and you expect next year to go up. Well, we want to do some planning around that. Would I want to prepay expenses and get more expenses on the books in a year that I'm going to have a lower income if I could use those next year when I'm in a higher tax bracket, when those expenses are going to give me even more tax breaks because I have more income next year. Do some of that planning and let's plan around that. When we talk about timing, there's a couple different strategies we look at. It might be prepaying expenses. Maybe you're thinking about, okay, I got rent next year. This is a big income year. I'm going to prepay my rent for next year. Get a deduction this year. The IRS has a safe harbor for that. If you have a low income this year, we probably say, let's not do this at all. Let's actually hold off on expenses if we can, and let's get them into next year when we're expecting to have a higher income this year instead of taking a deduction in a low income year when I'm in a lower tax bracket. So just some planning around there. The second strategy we talk about timing is delaying your billing. So, let's say that you're in a high income year and next year is going to be a low income year. Maybe we're going to say, hey, instead of sending those invoices out at middle of December, late December, maybe we're just going to hold off. We're going to send those invoices out January 1st and get paid so that income is going on next year. Again, this is for cash basis filers, but there's some plan there. But again, be strategic. Analyze what is this year's income going to be like compared to next year's and see when it makes sense to do some of that. These are just some end year opportunities. The other thing I want to talk about is credit cards. If you put an expense on your credit card, now I would never recommend somebody to spend something on a credit card unless you have the cash to pay it back. But just one thing to note, that if you put something on a credit card, you get the deduction in the year that it was charged. So if you buy a $5,000 computer on the middle of December, if you buy that $5,000 computer middle of December, and you use your credit card, you get a deduction for that computer as long as it's placed in service this year, even though you're not going to pay that credit card until next year. Totally fine. The other thing I want to talk about when it comes from a timing perspective is a Roth conversion. Converting retirement accounts that are traditional monies into Roth can be super powerful. Now, the problem is when you go from traditional retirement accounts into Roth and you convert them into Roth, you have to pay taxes on that, but you're not getting the cash. It's just going from one retirement account to the other retirement account, but you got to pay cash in that year that you convert. Well, oftentimes, I'm talking to business owners and we're saying, hey, we have big deductions this year for whatever reason that might be, or we're in a super low income tax bracket when we're typically higher. Now is a great opportunity to say, hey, let's maybe look at a Roth conversion, especially in those low income years. Can we convert some of those traditional monies into Roth and create a better benefit for us when it comes to retirement time? So think about those Roth conversions as an opportunity. Now, a couple miscellaneous items. First off, if you have an asset that you purchased, make sure you put it in service. This is huge. In order to get that deduction in year one, that asset needs to be put into service. So you buy a vehicle, make sure you're driving it at least 1 mile before the end of the year. If you bought a vehicle on December 27th and that vehicle was not delivered, you did not have access to it until January 2nd, guess what? That vehicle goes to January. That's not a deduction that you get this year. Same thing with rental properties. Maybe you're using the short-term rental loophole or long-term rental or whatever it might be. Make sure you're putting them in service. Make sure you have a few rentals of those properties to show that property was put into service this year. The other thing I want to talk about is tax loss harvesting. And this is if you're facing a capital gain. Maybe you sold a bunch of stock. Maybe you have a gain coming from a stock. We want to look at it, and this comes in crypto too. Do you have a loss in another type of stock or another type of asset that you could sell that to use that loss to offset your gain? They call this tax loss harvesting. We sell something at a gain, we have something at a loss. Can we use that loss to offset that gain and then get into a similar type investment down the road? There's a lot of planning around that. Talk to your financial advisor, see if this would play into anything that you have there. So this would be for stock sales, crypto sales. See if you're facing a large capital gain from a sale like that, a stock or crypto, see if there's a loss, a position when you're at a loss in that you could sell, take that loss, offset that gain, and then reinvest cash into that, a similar type asset, or wait past the wash sale rules and invest into it again. And then finally, in this category, I want to talk about charitable contributions. If you're making contributions to a charity that you want to qualify as an itemized deduction, charitable deduction, you need to make sure those contributions are made by 12/31. If you take that check out or take those cash out and you're going to make a contribution to a charity and you do it on January 2nd, guess what? It's a next year charitable deduction, not this year. So make sure you're making charitable deductions by the end of the year. Now, a couple things to prepare for year end, because year end's very close. And so a lot of the times when we're planning like this, there's not that much opportunities away, but I want to make sure that you're prepared. So a couple of things that you can start doing now to prepare for the new year, to make sure you start the new year off right, to make your January as easy as possible. Number one, collect data for 1099s. 1099s are when you pay contractors. When you have contractors that you make payments to, you need to send them a 1099 by the end of January. Now, in order to send them that 1099, you're going to need a W-9. That's going to give you their business name, their address, their social security number, or their EIN. So make sure you're collecting W-9s now so that when January turns around, you can start to prepare and send out those 1099s. So that's number one, collect data for 1099s. Number two is make sure you save receipts. Anything that we do, whenever we're talking about tax strategy, we want to make sure we have receipts on file that can help back that up. Now, don't have a shoebox of receipts in your office. Take a picture of it, write on the receipt who, what, where, when, why, everything about it, why it's business related. Run the receipt, take a picture of it, store it digital. You may never need that receipt, but if you do, you have it available to you. So make sure that you're just kind of collecting, getting those receipts on file for you. The third one is strategy documentation. And when I talk about tax strategies, I always talk about how implementation and documentation is so key. Documentation is what helps you sleep at night. Documentation is what helps solidifies what you're doing. Documentation is what's going to make an audit easy. If the IRS comes knocking, you're going to give them this documentation for all these strategies, all these things you did. They're going to look at it and say, okay, you're good to go. Moving on to the next audit. That's what we want. So make sure that when we're implementing these tax strategies that we're doing correct implementation and having that documentation on file. You know, I see every single day talking to business owners where they're implementing this strategy or they're doing this, but they have no documentation. They have nothing to support it. And I always tell them, I said, you got to get these things in place. If the IRS came knocking and they said, hey, I see that you paid, $15,000 for the 14-day home rental rule, or I see that you paid this child $15,000, and you say, yeah, I did. They did work for me. They did this. They say, okay, send me some of that documentation. And you have nothing. You have nothing that shows why it's a reasonable rate, what work they did, nothing to support that strategy. Guess what? IRS says, nope, strategy not allowed. So make sure as part of tax strategy is correct implementation, making sure that we're doing these things right with the documentation on file to help defend it if we ever need it. Final piece for year end is bookkeeping. Get your bookkeeping up to date. This can be a thorn in the side of a business owner and can go on for months and months and months after 12/31. If you haven't done any bookkeeping, do it now. Get it done before 12/31. If you do it now, guess what? You got a couple weeks to finish up that happened between when you got it done and the end of the year, and you're gonna be ready and prepared for tax season. Now is a great time to get caught up on bookkeeping, making sure things are accurate, do a review of it. Do things look right? Is everything in the right place? Are things looking good? Make bookkeeping a priority and start it now. It should have started at the beginning of the year, but start it now if you want to have a nice, clean, easy tax season. Finally, I want to end today with this concept of overwhelm. Today, we talked about a ton of different strategies. We talked about a ton of different things that you need to do. But this shouldn't be the first time that you're hearing about it or the first time that you're looking to implement it. Because guess what? If you haven't done anything on the checklist that we went through today, you're going to be in for a hurt. You cannot complete all of this before 12/31. So if you're feeling overwhelmed and being like, man, I'm going to have so much taxes to pay, I don't have enough time to do this, what do I do? Pick a few strategies and implement them correctly, and use this as a lesson to say, next year, I'm going to take tax planning seriously. Next year, I'm going to make this the year I pay the least amount in taxes legally possible. So I know as a business owner, we get caught into different things, and now it's the end of the year, and now it's like, I got to rush. I could get all these different tax strategies implemented, and I know that can feel overwhelming. Don't try to do it all. Use this as a lesson. Get what you can done. Pick 2 or 3 of the highest hitting, the best results you're going to get. Pick 2 or 3 of the strategies. Get those done before 12/31, and then use this as a lesson. Make it a priority that as we start 2026, 2026 is going to be the year you pay the least amount of taxes. So try to get that done. Try to create that mindset to make a change if you're in that situation. Now, if you're on top of it, you're marking off as we're going through today, you're done. Great. Continue to do what you're doing and continue to dive further. And again, make sure that implementation piece is correct. Because I talk to a lot of business owners that are implementing these strategies and doing things, but they don't have documentation for it, or they're not utilizing the strategy to its full extent. So if you're that person that's checked everything off, don't just think you're done. Review it. Make sure, first off, you have the documentation on file. But second piece, make sure you've done the strategy to its full extent. That's going to give you the most amount in tax savings. But here's the bottom line. December 31st is a finish line. Not just for the year, but for real, tangible, money-saving tax moves. If you are able to take action now, even just one or two of these strategies could save you thousands of dollars. But if you are feeling that this year's already slipped through your fingers, don't beat yourself up. Use this moment as a launch pad, a learning opportunity. So when 2026 rolls around, you're not reacting, you are leading. You are leading the fight to tax savings. And if you found this helpful, don't forget to subscribe. Hit that like button and share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax professionals implementing all the strategies we talked about today and so many more, visit taxelm.com. That's TAXELM.com, or click the link in the description for our free discovery call. We are helping people like you legally lower your tax bill every single day. Thanks for watching, and I'll see you on the next one.